How do derivatives create large market exposure with a small investment? Imagine you believe the S&P 500 is going to rise over the next year. One way to benefit is to buy shares of all 500 companies in the index, but that would require hundreds of thousands of and possibly millions of dollars. For most investors, that's simply not practical. Now imagine there's another way. Instead of buying every stock individually, you enter a derivative contract whose value moves with the S&P 500. Suddenly, you have gained exposure to the performance of entire index without purchasing every company yourself. This is one of the biggest advantages of derivatives. They allow investors to control exposure to a large asset or market with a relatively small upfront investment. You are not paying for the entire value of the underlying asset. You are entering into a financial contract linked to that asset. This is why derivatives are widely used by hedge funds, pension funds, and institutional investors. They can efficiently gain exposure to entire market sectors or asset classes without drawing up enormous amounts of capital. However, this works both ways. If the market moves in your favor, your returns can be significant, but if it moves against you, your losses can also grow quickly. That's why derivatives are considered powerful financial tools. They increase both opportunity and risk.